What's going on, YouTube? Welcome back to Stocks by the Numbers. Today I wanted to take a quick look at a company that someone brought up to us because, as you see, it was up significantly higher than where it is now. It's been having a really big sell-off for about the last 11-12 months straight, and I'm sure a lot of people now may be considering it and watching it thinking that we can step in and buy this at a deep discount. So let's see what's going on. Name of the company we're looking at is Enphase Energy. Ticker symbol is ENPH, listed here on the NASDAQ. Now, the company right now, $126.18, up a little over 4 points here on the day, about 3 1/3%. So as we see, the stock was well over $300, almost triple this price here, and again has been significantly selling off and dropping down, even though looking at some of these numbers, we can see that we have several beats in a row here, and finally one small miss, we'll call it small miss, 2% miss here on the revenue side. Last quarter back in the tail end of July. So let's see what's going on here. First of all, since the last earnings report here, you can see that the stock chunked down and then kind of channeled downward here in this little range. So I drew my little trend line here connecting top to top to tops, and you can see that it's basically right where this candle, actually it's off a little bit. There you go. So you can see that, it jumped up and closed it closed 122.09, which, a little hard to tell, but you can see is slightly above this top trend line here in this descending wedge. And now you can see today we have a nice 3% pop and we're above that wedge. So in my opinion, if you're asking the immediate short term, you could potentially retrace back here and meet up with this 20-day moving average that's been pulling down with it. So this stock could easily keep going up to maybe about 133 and change, 133 and a half before potentially rejecting. And I think it's going to continue to stay down in this range and wait for this earnings report, because as we see, estimates 587 million, a little over that. And if we go back the last couple of quarters, you can see that the company was coming in with well over 700 million. So we would have to go back, there's 600 million. We would have to go back to here, this same July quarter of last year, when the company reported revenue in the 500 million range. So that, in my opinion, would be a red flag here just to start off. And again, I'm not bashing the company. I'm not saying it's not a buy, especially over time, because over the years, lately, they've been doing significantly better. So, I can appreciate the fact if you're looking to grab some shares and tuck this away for the longer term, because overall the company does seem to be growing. So I'm definitely not bashing the company at all here. But what concerns me, again, is that dip down in revenue. And now what's going on is, because it's been in such a downtrend, because it was so significantly undervalued, it could actually, technically, in my opinion, still be viewed as potentially overvalued if we look at the numbers. Not the worst we've seen, but could potentially be viewed as overvalued. And this is why this is actually a rough scenario, because right here, if the company comes out and posts like 597 million and they beat estimates, well, then again, we're going to have the long-term technical descending wedge setting up, which technically is bullish. And of course, right near the apex, you're going to have the catalyst of them beating earnings estimates. So boom, that's going to help pump it back up into the 140s and potentially even into the 150s here. But again, if it's still viewed as slightly overvalued, and then they come in and they post like 550 million and like completely miss the mark here, now it's back-to-back quarters that they missed on revenue, and with estimates dropping down, roughly 150 million, them still missing on that lower kind of low ball estimate may potentially just bring this stock back down to like $100 a share. So as we see here near the bottom of the trend line here is about 108. So yeah, I don't know. I have a feeling maybe it'll be like 110 maybe like 112-ish, while they go into these earnings. And then, well, actually, you could have a rally actually going into the earnings. So obviously, based on what I just said, you now came to the conclusion that, of course, anything can happen, which everyone knows. But long story short, it'll probably rally the day or two going into earnings. But again, it'll probably reach the top trend line there, 123, and it could immediately reject that. That's why I'm saying it really could get bad in a hurry, believe it or not. And if we extend this out here, see, this is why our trend lines are important, because in my opinion now, if we break down here, 80 is a little extreme. However, it can slowly begin to start trending downward towards that level, believe it or not, because Now, that 80 mark, you're talking about what, like a 33% drop from this level, right? So let's look at the numbers real quick, because the market cap is still up north of 17 billion. It's at around 17.2 billion, we'll call it. We got a PE about 31, and as you see over the last several quarters, the EPS has basically been in an upward trend, and of course it's dropping down here, Q3 of 23, coming out the end of October. But if we look annually at the growth of this company, you cannot deny the fact, we can all understand as to why this stock price was going higher and higher consistently. It's because the size of the company and the growth of the revenue and the actual business that they're bringing in is consistently increasing year over year, going from over 300 million, doubling to over 6, almost 800 million, and then a big chunk up to 1.38 billion, and then up to 2.33 billion, almost a billion dollar gain year over year from 21 going into 22. So, and of course, the company has been basically remaining profitable the entire time coming out of 2018 when revenue started to pick up. So, even looking at quarterly, look at that, steady growth there up to about the 700 million plus mark. And even though they haven't consistently been increasing that number for the last couple of quarters, they've been maintaining that 700 million plus mark. And of course, you can see the profit margin has been staying above 20%. So that's what I'm saying. You can't deny the growth. However, again, you're bringing in 2.33 billion. And right now, your market cap is 17.2 billion, right? So what's that, like 7.5, 8 times earnings, 8 times yearly revenue. So that's what I'm saying. That's not the worst annual revenue to market cap comparison we've seen. However, again, it could be viewed as slightly overvalued. I mean, that can easily drop down to like 5, 5.5, 6 times annual revenue, which of course 6 times annual revenue would be 12. That would be like 13.8 billion, which as you see is like a $3.5 billion haircut here. Which would be 16, 17 to potentially 20%. And 1/5 of it right here from this current level would bring you down to about $100 a share. So that's why I'm saying it could get ugly in a hurry here if this company does miss earnings. But as you see, it was completely overinflated, and again, it's going in this downward channel even with the beats on the top and bottom lines throughout this whole time. And what that means is that the stock was overvalued. And this is what I talk about when I say, as the revenue's coming in, you can have a stock that's dropping down if it was overinflated to begin with. And this is why sometimes you'll have a company that beats earnings and reports some positivity, but all of a sudden it drops down a couple of percentage points, and people don't understand why. Well, I can understand why. It's because the stock was up at triple this price, which means the market cap was north of $50 billion from this level probably, and the PE was out of control. And then someone, all the people came down and looked, and they said, wow, the company made $2 billion last year, but we have a valuation of a $50 billion? Nah, no way. I'm going to short this. And obviously they made out like bandits, as you can tell, because this is what I keep saying. The stock has to come back down to earth and realign with the actual business, the revenue, and the earnings of the company itself. And then, and only then, can it set itself up to take that next leg higher. So that's why I'm saying I do think it should technically, in my opinion, continue to sell off based looking at these numbers here. But of course, you do have this catalyst setting up about 2 months from today. And if they do come in and beat, you could see a nice pop. Obviously, nothing is guaranteed, but if it stays in this range and then it rallies and they beat earnings, obviously you can make a pretty penny. But in my opinion, kind of undetermined here because, again, that big drop, this looks good here. Nice, steady, stable, maintaining that business, climbing from 5 to 6, and then maintaining that $700 million mark. But now you're dropping not back into sixes, but to 587 million. So that's why I'm saying to lower estimates that much, and then if the company happens to miss that number or report that, operating margins took a massive hit and came in below expectations or something like that, trust me when I tell you, they're going to beat the stock up because it could afford to get beaten up because it's slightly overvalued, in my opinion, looking at the numbers. But overall, again, I do like Enphase. You cannot deny the growth here. You can see here over the years coming in above analyst expectations for annual revenue, annual EPS. Look at the debt, though, has definitely exploded, as you see here, starting from that 2018 level we were looking at, debt of a little over 100 million up to 118, almost tripling up to 350, and then almost tripling up again to 1.05 billion, now at 1.31 billion as of last year, 2022. However, of course, you can see the cash flow increasing as well. However, again, to see that consistent increase in debt, and now we come over here and we see something like the long-term liabilities are now outweighing the long-term assets. This is a situation where, you could be seeing the beginning of the storm. Because they pumped it up so much and everything was so great. However, now a lot of this data is kind of reworking into the evaluation when these analysts are looking at it, and everyone may now begin to start lowering their price targets and saying that it's a little overinflated, and they might downgrade it to underweight because it was doing so well. So now it's most likely going to perform a little less better than compared to the overall market. You understand what I'm saying? So adding these up, you got about $3 billion in assets and about 2.3 billion in liabilities. So assets are still outweighing liabilities, which is a good thing. But again, the rising debt and the long-term liabilities, that's what could keep the company flat. That's my point also. It could also remain flat. It could stay down here in the low 100 to 120, 125 range, which of course would work out well for you traders out there if you can time the highs and the lows correctly. However, again, looking at the numbers and it being 7-8 times annual revenue, this revenue could jump up to 850 million, 900 million per quarter moving forward, and the stock could technically remain flat and it could still be viewed as fair valued because of how much of a higher multiple it's trading now compared to the revenue coming in. So that's why I would much rather, me personally, in a situation like this, the way I would play it is I would wait for those earnings, believe it or not. And I know it's a name, and I know it's in the wedge, and it's so low, so it could bounce and go higher. And listen, sometimes looking at it like that could work out in your favor, and you could be more successful, than you are unsuccessful. But I mean, listen, if this is something you got to read on, you got to beat on, and you're timing it right, and you stepped in when it was low 120s, and now you're catching a pop today just because you felt it was undervalued and it worked out. Again, like I always say, more power to you. Whatever works, do it. Whatever works, do it. And that's why, again, I always ask you guys to leave comments in the comment section, because I know that everyone looks at charts differently, everyone looks at fundamentals differently, and of course, we're all kind of watching all of these different stocks. Not everyone has the same exact watch list. So if there's something I'm not mentioning, or if I look at a company like this and I say, they're a little overvalued maybe, but there's potentially a big deal brewing, or, like these EV companies, how they get these tax credits or whatnot, potentially there's something that may not be taken into account. There may be a catalyst on the back burner that you feel over time is really going to benefit more than I have potentially, made it out to be. Let me know down in the comment section. Again, I don't take it personally if I'm corrected or critiqued, or if you throw out something, again, that I missed that we should all be keeping an eye out for. That's exactly what the comment section and the Discord is for. Again, shout out to the Discord gang. You use the link in the description of every video I put for the Discord if you want to come in, you want to talk about stocks, you want to BS a little bit, whatever you want to do. Of course, open to everybody. But Enphase here, again, overall, I do like this situation. And if you switch over here annually, of course, the more revenue they brought in, the more cost of goods, but again, have remained profitable. And you see something like the operating expenses have really exploded since 2019, 2020, going from 150 million now up to north of 500 million for last year of 22. So even though a lot of these numbers are really chunking up, again, coming back down, you can see that the company has been maintaining its profit margin. And of course, again, it dipped down here. However, it did have a nice jump up from 10.5% to north of 17%. So that's what I mean. I may look at a company and feel personally it's overvalued in the numbers. However, it's a company like this that if you told me, oh yeah, it's up, it's trading 7-8 times last year's revenue, it's more understandable, right? It's more understandable because you could say that if any stock out there deserves to be trading at a higher multiple, it should be companies like this. Companies that are consistently growing their business, signing new clients, consistently increasing revenue quarter over quarter, year over year. That's what I always say. That's why as much as I hate how high Tesla is trading, with its multiple to market cap to revenue comparison, again, you can't deny, going back, looking over the years, the significant growth that they had quarter over quarter, year over year, just consistently across the board. So again, as we see, those are the stocks that are being rewarded. And that's why a company like Enphase had that big explosion up to 330, 339, 92, 340 and change. It's more understandable. But again, me personally, I would also wait for a sell-off. Because again, after hitting those highs, it's been in that long descending wedge. So that's why I say, take what the market gives you. Take what the market gives you. Don't force your trades. But a lot of these numbers do really look pretty good. And as you see here, going back as of 2022, as we said, a little over $3 billion in assets, about $2.25 billion in liabilities. Yes, this number is increasing, but assets are still technically outweighing liabilities. We have our equity, which is assets minus liabilities. Equity right now sitting at about $825 million. And again, they have $1.3 billion. And if we look at the book value, see, this is what I'm talking about also. This is why you can't let the share price get out of hand when being compared to the revenue that the company is being brought in, right? Because now if you take all this debt into account and then you look at the revenue, right? Now this is what I'm saying. As of 2022, the book value is $6 per share. So, this company's trading 22 times book value right now. That's a pretty high multiple as well. We can look at a lot of other companies that may be doing just as well with the same growth, and they may not be trading 20, 30 times book value, and the company, again, trading 31 times earnings. So this is why when I notice companies like this that I feel are overvalued in the numbers, that's when I personally would just remain patient and just wait for the reversal to start, because once the reversal happens and it starts to begin to head downward, again, nothing is guaranteed, but it's a much, much safer bet knowing that that stock will come down because it inevitably has to happen. But we switch over here annually. Let's look at some of these numbers here, and you can see, look at how high the PE was. It was completely out of control. Again, 180 back in 20 and 21, and then again, those highs in 22 before it started to pull back before the end of the year, again, about 3 times higher than where it is right now. So that's why the PE out of control, the revenue to market cap comparison was overinflated, and that's why we say what goes up must come down. It just has to. And then when markets get volatile and everyone starts hitting the sell button, the stocks that chunk down the most are the stocks that went up the most. And that's why you'll have, these trending hype companies like your Enphases and your Teslas. These companies are heavily overinflated, even though they're doing good business. But again, if markets really begin to chunk down, those are the ones that are going to start taking the biggest hits because they can afford to. That's why I look at stocks this way. Because you may be buying something boring like a Hershey or a Campbell's Soup, but again, your max downside may only be like 10, 12% or something like that. But if you're buying something massively overinflated, if they really wanted to take it to the shed, you could lose 40, 50% of that investment just because you bought at such an overinflated valuation. So this is why I say you really have to, I know it's annoying, but you really have to do your due diligence. You do have to take a few moments here just to check out some of these numbers along with the chart and try to find something that just kind of slightly lines up and covers all bases. It's trading 6 1/3 times sales, not the highest it's been. excuse me, over here, not the lowest it's been, so that's kind of mid-range. And that's why right now it's good to look at some of these fundamentals, but right here I really wouldn't use it as a definitive indicator of when to buy, when to sell. But right now, 17 times book, as you see, was usually over time much, much higher than that. However, was lower than that as well. So that's why I'm saying if they can bring it back down to like 10, 12 times book, but of course that would be 50% from here. That would be like $60 stock. So that's what I mean. That's a little extreme, but again, even bringing something like that down to like 15 would be a big deal, because again, it would be more fair valued. More people would be inclined to step in at that level, knowing that it's fair valued, and over time it would probably grow and make them good profits over the months and over the years, and that's when more and more money would come into it, helping the rally even more. So that's why we say, of course, pricing is important, and of course timing is important, and if you're able to time both of them, well then obviously you're making some serious profits here. But as we see, the return on assets has gone up a little bit, over the last several years. The return on equity has made a nice jump up, along with the return on invested capital. The gross margin has been basically growing. Again, we had a high back here a couple of years ago of a little over 44 1/3, dropped down, but still maintained above 40 and 41, and now back up to 44 1/2. So that's why a lot of these numbers, despite being a little overvalued in my opinion, a lot of these metrics are setting it up, I feel, for it to take that next leg higher. But it just has to happen at the right time. The EBITDA, as we see, again, earnings before interest, taxes, depreciation, amortization, as we see, came up from negatives to single digits, jumping up to 26.4%. Dipping back down to sub 18, back up above 21, now currently sitting at about 26.5%. So that's what I mean. This company really seems to be doing a lot of things right. We looked at the profitability before. They went from negative to positive. Again, it bounced around. It dropped down to 10.5%. Then they had the nice rebound going into 22, bringing it back up to north of 17%. Now it says it's currently sitting at about 22.1%. But again, this is for the current year, which is not over, but so far they're looking pretty good. And of course, we used to look at the inventory turnover as well. And obviously, as we see the numbers going up, that is a good sign. And then you see the numbers dipping down, having a slight rebound back up to north of 14, and then have since slipped down to 12 and now down to 10. So this is what I mean. This is why when you have a company that could be viewed as overvalued in numbers, like I laid out to you guys, this is why it's like any metric like this that goes down would justify them selling off the stock and lowering their price targets and downgrading the company. You understand what I'm saying? Just like we saw with PayPal, right? PayPal came out, they beat on the EPS, they beat on the revenue. But what happened? Operating margin came in at 21.4%. Estimates were 22%. Boom, they brought that down and had to hit new lows. Did it really deserve it? No, not really. But also at the same time, if you went back and you looked at the revenue to market cap comparison as well, you could say, well, I think at the time it was trading maybe like 7 times, 8 times annual revenue. So that's what I mean. If they could in any way be viewed as overvalued, if any negative comes out, it could really hurt the stock more than people think. And that's why I always like to look at the numbers, and that's where I started the channel, because if you just look at the chart and you're just looking at patterns, you may be missing something that is staring you right in the face, that regardless of any pattern or trend you may be seeing, it could be completely opposite moving forward. So that's why I say you kind of have to look at everything. And the asset turnover here as well, very interesting. Asset turnover, revenue divided by average total assets for the last period. And it says here asset turnover can be used to measure the effectiveness with which a company uses its assets to generate income. The higher it is, the more efficient the company is, since higher ratios mean that the company generates more income per dollar of assets. And conversely, obviously, the opposite. So this is interesting also, because you have the asset turnover up here. It was close to 2. Excuse me. And now you see it kind of just consistently slipping, drops all the way down to 0.81, and has since slowly begun to rebound. Now, of course, this rebound here climbing back up is a very good sign. However, also at the same time, it was basically double what it is now, several years back. So this is what I mean when if a company is overvalued in the numbers and there's 1, 2, 3 negative metrics that could bring it down, that's what's going to help accelerate the sell-off. The company's not paying dividends. And again, we looked at earnings. Again, they slightly missed here on the revenue. Before that, a lot of good quarters in a row on the top and bottom line. Switching over here annually. Last time they missed on revenue estimates was back in 2016. And on the EPS side was back in 2018. So, even before, pandemic and all that nonsense, and after it, obviously, the company has really been moving in the right direction. And you see revenue chunking up as well. And I just wanted to check the forecast quickly before I move to stock charts. As we see, we have a ton of coverage by analysts on this stock. We have 22 analysts putting a strong buy recommendation on this company. 2 telling you to buy it. Honestly, I never really understood the difference because, of course, I can appreciate the fact that there's higher conviction. But I mean, if you're sitting there thinking a company is going to go up over time, then it's a buy, right? It doesn't matter really if it's a buy or if it's a strong buy. I mean, like how would you really differentiate the two? I mean, a buy is a buy and a sell is a sell. However, I guess you can say a strong buy means, buy it immediately right here. It doesn't matter where it's trading, it's going higher. However, that's a pretty bold statement to say. But anyway, I'm going off on a tangent. 12 people telling you to hold it, which in my opinion just means they're too scared to give a direction. They're probably getting paid, well into the 6 figures. I mean, if you can't tell me whether I should buy or sell this stock, you shouldn't have this job. But, that's just my opinion. But here we have one person coming out and saying to sell. Give a lot of respect to that person, because when you have 34, 35 other people telling you to buy or hold, and you're the one guy that thinks it's overvalued and you're giving it a sell, let me tell you something, that guy's probably catching some crap for that. Just between them busting his chops. But overall, you can see that practically every analyst out there is saying that they feel you should either be buying or holding Enphase Energy, ENPH, here on the NASDAQ. So that's why, again, as we looked over the last several quarters and, of course, over the last several years, that's the growth. That's what I mean. So when an analyst sees what we're seeing here, it's a buy, right? It's a buy. You don't have to be a rocket scientist to understand what's going on here. It's a buy. It's a buy. And obviously, if these numbers were heading in the opposite direction and they were trending downward, it would be a sell. Switching over here to stock charts. Do a quick update here, and I'll let you guys go. Okay, we've been pulling back. Yes, we popped out of that wedge. See the rejection the day before off of the mid-Bollinger Band. Now it chunked up and got above it. It does look like markets are pulling back. I know I'm coming to you kind of late with the video. The Fed announcement, everything dropped and then kind of went up, but now everything's kind of dropping again, and that's why I say any days with these Fed announcements is ridiculously risky and volatile, and you either have to be immediately in and out, or you have to remain patient, and that's what I mean, wait 30, 60, 90 minutes after the announcement before you take, your trade or your prediction, whatever. But right here you can see we got back above that Bollinger Band, and that's why we looked over here, and the 20-day, as I said, like in the low 130 range, and now you see the top Bollinger Band is just a touch below 131, so that's why I feel you could have that run to 131, 132, get near that moving average we looked at, and then it could potentially reject or just kind of flatten out moving forward. The MACD on the daily has been rising for about like 4 weeks straight, so yeah, not really sure I would use the MACD there as a big indicator, but again, chances are if everything goes according to how I'm predicting it, it'll get up again to that 131 to 133 level and then probably reject and start dropping, and that may cause the MACD to cross to the downside, and that may push it back down to the bottom trend line there of that channel. But RSI here, kind of mid-range here, 45.66 on the daily, so again, slightly above that oversold mark, hasn't hit that overbought mark. So it's right mid-range. So this is why I say take what the market gives you. Something like this, mid-range of the Bollinger Bands. Now it's mid-range kind of the long-term descending wedge we looked at, right? The RSI on the daily is mid-range. So again, take what the market gives you. This reminds me of the Nikola video yesterday. Don't force trades. On the weekly, the RSI down at 35.66, which is pretty low. Looks like it hasn't been really down there. Obviously, recently it was, but I'm talking, before that longer term, hasn't been back there since the beginning of 2022. So again, I don't really know if I would look at that as a good sign or as a bad sign, but not really the best indicator. Not really the best indicator. Again, this is why I say, in the numbers, in my opinion, it may be viewed as overvalued and could continue to go down. However, looking at a lot of these other metrics and indicators, of course, anything can happen, which is why me personally, I would just kind of sit on the sidelines. That's how I, in my opinion, would play this right now. But you can see on the weekly, the MACD has basically fallen off a cliff and has been just kind of dying and flat for the last month or two, but kind of been in a downtrend since right before 2023 began. So this is why, I know you might not time the bottom and you might not catch it perfectly. However, also, this is why a situation like this, you want to wait for confirmation. You want to wait for confirmation. I'd rather get in late at 130 and miss this, 5, 6, 7 point run up from the lows. But I would be confident, hypothetically, of course, I would be confident in knowing, okay, we should get to like 147 and I'm going to make money here, right? I would rather wait for the confirmation to make money as opposed to just rolling the dice and saying, oh yeah, it's probably too low here, I'm buying it. Like you really shouldn't do it that way, in my opinion. You really shouldn't. But again, the RSI down here, it does look low, but nothing is guaranteed. It doesn't have to rise up from there. And MACD, again, I would wait for that cross because it's been kind of fizzling out for about 12 months straight now, right? So let it regain itself, let it cross, let it confirm, and then potentially consider stepping in on something like Enphase ENPH. But here, if they do come out and really annihilate and potentially announce a share buyback or any positive catalyst like that, that's what could pump the stock back up probably to like that 140-ish range it was holding for quite a while, and then potentially get it back up to like this 158 fib level, maybe was at 158.81, and then we switch over here, look, and if we look weekly, you can see that's where the support and the resistance, the last real solid one, in my opinion, was. It was right here at the 200-day moving average. So that's why if the stock begins to start rising over time, they will bring, obviously, this 200-day moving average up slightly. And that's why, like that 158, 159 mark, it could easily hit that level, 158.81, 157.94. So that's why it could definitely easily hit that number. However, remember, if the catalyst we're looking for is earnings, that's not happening until the end of October, roughly 8 weeks from today's video. So, again, in my opinion, I wouldn't force your way in. I wouldn't force trades. I would wait for the market to, wait for what the market gives us, and not force trades, and I would let it run up and possibly reject and come back down, and that's what I mean, like the low 100s here, a couple of weeks before earnings, potentially catching it bouncing off of this bottom trend line or something. I would try to, catch it there and potentially catch that rally going into earnings. However, again, depending on how you want to play it. If you're doing a longer-term investment, then, this obviously would be like your ideal entry price here, in the immediate short term anyway. But if you're doing it more of a shorter-term trade as well, what you would want to do is, in my opinion, the way I would play it is I would get in here, 110, 109, 108, and then just catch that rally up to whatever, 117, 119, going into earnings, and then obviously you would want to sell before earnings, because if earnings miss, you're going to give all those profits back or potentially even take a loss, right? So again, we're here to make money and make profits. So if you're able to get in at 109, bouncing off the trend line, and it rallies to 118 right before they post earnings, I mean, you just caught a big rally. Your options would probably be up significantly. it would be in your best interest to sell, in my opinion. And if you want, you can leave, 1 or 2 trailers, they call it, just in case they do happen to beat earnings and explode, But I'm going to end it there. Enphase Energy, ENPH. Again, I do like it in the long term, but again, basically the Buffett method. Basically the Buffett method, right? Let's not force our way into trades. Let's not overpay per share, right? Because we know markets could drop and anything can happen at any moment. So you don't want to force your way into something like this at 125 a share, and then down the road you see you could have just waited and now you could buy it for 95 a share, right? That's a horrible feeling. So that's why when you're going to step into these companies, find good companies. And again, Enphase seems to be growing over the years, so I'm not saying it's a bad company. But what you want to do is you want to find good companies like that with decent growth, but you want to buy them at a more attractive price. Don't just force your way in because, everyone's talking about it or it's trending on stock twits, right? That's a piss poor reason as to why you should take your hard-earned money and try to step in and roll the dice with a play like this. You should wait for what you feel is an attractive discounted price. And I'm going to leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, like the video, thumbs up, algorithm, helps me get more eyes on the channel. Share the video. And also, subscribe to the channel. That is our handshake agreement. I will review companies like this that you guys asked me to. I'll try to bring you situations like I mentioned Campbell's Soup back in a video. And also we have some smaller cap companies moving, like our Soundhounds, our Stems. And also, if I have any potential short-term day trades, I'll try to mention it in the Discord. Of course, that is just my opinion. Nothing is set in stone. Whatever you do with your money or my information is entirely your own prerogative. But of course, if I personally see something that I would consider, in my opinion, maybe taking that position in, I'll mention it to you guys in the Discord. And if you want, you can step in and take a shot. But again, I will do all of that for you guys. All I ask, just do me a favor real quick. Just push the subscribe button. That is how you help me help you. That's all I'm asking right now. So moving forward, more importantly, though, like I do always say, I understand that markets are rocky and they're volatile and they are very uncertain, as we see now. NASDAQ down huge, over 1%. The Dow has turned red. Shout out to the Discord gang because I called out DIA puts when the Dow was up 150 points higher than where it is now, so obviously that headed in the right direction. But more importantly, moving forward, again, I understand markets are rocky and volatile and uncertain, but I really do want to wish all of you success. I hope everyone makes a couple of dollars. I want to thank you guys for stopping by today. Have a good day. I'll catch you in the next one.